Live via satellite from Washington, D.C., the Price Waterhouse Tax Reform National Teleconference. This special program is being transmitted via private network to 50 Price Waterhouse practice offices throughout the contiguous 48 states, Alaska, and Puerto Rico, for viewing by an invited audience of Price Waterhouse guests. This program is also being monitored and recorded for possible later broadcast by major domestic and international news organizations. And now, here is your host and moderator for today's teleconference, the Price Waterhouse Vice Chairman of Tax Services, Dominic Tarantino.
Good morning, ladies and gentlemen. On behalf of partners of Price Waterhouse, I would like very much to welcome the more than 20,000 participants in cities across the country to the teleconference on the Tax Reform Act of 1986. Price Waterhouse is especially pleased to provide this unique teleconference as one part of our comprehensive response to the challenges and opportunities posed by this new tax law. Client seminars in offices nationwide to address specific industry implications is another one of our responses, as is the Price Waterhouse Guide to the new tax law, to be published later this month by Bantam Books. The 1986 Tax Reform Act is without question the most impressive piece of tax legislation in over 30 years. It's been an immense and exhaustive undertaking. Although the statutory language is not yet available, it is rumored to exceed 2,000 pages. Clearly, it will have far-reaching effects on our business as well as personal economic decisions. None of us has seen the statutory language, or for that matter, the Statement of Managers, which is the explanation of the action taken by the tax reform conferees. That report is expected later this week. Nonetheless, we can provide some additional insight based on information we already have. We do want to focus your attention on those areas of this most comprehensive legislation that requires your early and thoughtful planning efforts. Today's program will begin with a question and answer session where my Price Waterhouse colleagues will join me in posing questions to our distinguished guests. Following that, our Price Waterhouse panel will present an overview of the bill and our current interpretation of some of its most important provisions. There will be then an opportunity for questions and answers from our nationwide audience, coming from Price Waterhouse receive sites so that you can gain some additional information on how the tax reform package affects your business and personal planning. You should direct your questions to our Price Waterhouse practice office hosts. And now to our panelists and our distinguished guests. Our panel includes Roscoe Eger, who rejoined Price Waterhouse in June after 5 years of distinguished service as Commissioner of Internal Revenue. And my partners, Bob Shapiro and Mark McGonaghy, former Chiefs of Staff of the Congressional Joint Committee on Taxation. Roscoe, Bob, and Mark reside in the Price Waterhouse office here in Washington, D.C. And I might say reside they have, considering the midnight oil that has been necessitated by the demands of our clients for information during this legislative process. We're very pleased to have with us today, to begin our presentation, the chairman of the two congressional tax writing committees that produced the Tax Reform Act of 1986. They will be answering questions about the bill and any changes that they might anticipate to the federal tax law in the near future. Representative Dan Rostenkowski, chairman of the Ways and Means Committee, is a Democrat from Chicago who was first elected to Congress in 1959. He served as Chief Deputy Whip from 1977 until 1981, when he became chairman of the House Tax Writing Panel. Senator Bob Packwood chairs the Senate Finance Committee. He's a Republican from Oregon and was first elected to the Senate in 1969. He became chairman of the Finance Committee in 1985 after having served 4 years as chairman of the Senate Commerce Committee. Both of these chairmen have expertly guided their committees, often in the face of much adversity. Each has literally snatched this bill out of the jaws of defeat on more than one occasion, and they finally produced the most extensive rewrite of our tax laws in more than 30 years. Our first question will go to Chairman Rostenkowski. Good morning, Mr. Chairman.
Good morning.
Thank you very much for being with us this morning.
It's nice to join you.
I know that our teleconference audience would be very much interested in your assessment of the timetable for House action on this bill.
Well, what we'd like to do is file a report, and the only reason that it hasn't been done yet is because of the technical language. I think what we're interested in is getting language in place so that we aren't going to have that large technical correction bill next year. But I'd like to see a report filed no later than Thursday of this week, and possibly take the bill up on the floor of the House of Representatives on Tuesday or Wednesday of next week. We had anticipated doing it this week, but it's the technical language, I think, that's holding us up, and it's justifiable. I really would like to see the legislative documentarians put language in the bill so that we aren't going to see a revisitation.
Surely. Senator Packwood, welcome to you to our conference.
Thank you.
Nice to have you with us. Let me say that we've heard an awful lot of conversation that there is some opposition to the bill in your chamber, especially from some of your Republican colleagues. I think our teleconference guest would like very much to know whether you anticipate that will affect the timing of Senate action.
Only in the sense that it may take us 2 or 3 days instead of 1 day on the floor. There will not be a filibuster, but there may be 8 or 10 senators that want to speak for any place from 1 to 3 hours apiece. And at the end of it, we'll vote. We'll take it up 2 or 3 days after the House finishes with it, and I would imagine after 2 or 3 days of debate, we'll pass it.
All right, it sounds from what you're both saying then that the legislative aspects of the bill should conclude perhaps by the end of September. And as I understand it, it takes another 10 days or 2 weeks to roll this bill up to the White House to the President's desk. And therefore, would it be fair to say that our guests could anticipate that the bill would be signed sometime in the middle of October?
I think that's a fair guess.
I'd like to see it done a little earlier that for other reasons, but I'd be satisfied with October, the middle of October.
I think what the chairman is saying is he and I both might like to go to a signing ceremony in the White House, but we can't if we're back home campaigning.
Chairman Rostenkowski, I've already alluded to the fact that the legislative process has, shall we say, been a rocky one. Could you share with our audience some of the highlights and perhaps lowlights of this process in the House?
Well, Dominic, I don't know of any legislation that has had more wakes than this particular bill. I might hasten to add, however, that it never had a funeral. There were times in the committee in the markup that I think that I was in a valley. A banking provision that set us back that was even more generous than present law, that after about 2 weeks, 10 days of consideration and pressure, we changed that. I think losing the rule on the floor was a very low point. But the confidence that I feel in the legislative process developed, the fact that members responded positively, the fact that the president
showed up,
activated. I think that's the reason that I'm most proud of what we've done, because we saw a problem out there and people were becoming frustrated with their government. We've responded. The highlight naturally was when we passed the bill in the House. The low point naturally was when we lost the rule originally.
Surely.
But I think that in the long run, when we're down at the White House, I hope sometime in October, that we'll have restored confidence in the legislative product by the people of the United States. That I feel is what I'm more concerned with than anything else.
Senator Packwood, how about the high points and low points in the Senate side?
I didn't have to go through quite the low points that the chairman did on the House side, because once they had passed a bill, and of course until they passed a bill we couldn't pass one, Once the House had passed one, I was confident we would have a bill of some kind, because every time a president has asked for a tax reform bill, he has got a tax reform bill. It may not be what he thought, but he's gotten a bill. So had we not passed the bill we passed, we probably would have passed a pretty good corporate and individual minimum tax bill. We would have had some reforms in it. We would have gone to conference with the House and reached a bill. So I never had to be faced with a situation of would we have no bill. I suppose the riskiest point came when we were not doing very well on the bill we were working on, and I went to lunch with my chief counsel, and we just sort of rolled the dice and said, let's go for broke. Let's see if we can draft a bill that is simply an extraordinary leapfrog of everything else we've been talking about. Put that bill before the committee on a Thursday, and 12 days later, it passes. When you consider all of the labor and pain that has gone into this bill and the days and months of hearings, to in 12 days go from a radical bill to a 20-0 vote in the Finance Committee was obviously a high point.
Certainly. Bobby?
Chairman Rostenkowski and Chairman Packwood, welcome. It certainly is a distinct pleasure to be here with you on this panel today. My congratulations are to both of you for the magnificent job you did in guiding your respective panels on the major successes you had in your tax writing committees. Also, the major accomplishment that you had in the tax conference, bringing that bill forth that you have so far. I must say that Mark and I both have a little regrets about not being with you and sharing that opportunity. But I must say, at the same time, both of us have something else telling us that through the hectic pace that you have had, being on the sidelines wasn't all too bad through various those moments. Chairman Rostenkowski, would you tell us which provisions in the tax reform package you are particularly proud of? Are there any areas in current law where you had hoped for change or were unable to sway other members of the administration?
Well, Bobby, let me just allude first to the fact that you weren't among us. I learned a lot about the Capitol at 4 or 5 o'clock in the morning as I was walking around the Capitol with Bob Packwood discussing the bill. But what I'm the proudest of, I think taking 6.5 million people off the rolls and allowing those people to understand that in at least that instance, it's simple. When you're writing provisions in legislation that are as difficult as we have written, I don't think you can say it's simple. But the fact that we've taken the poor off the rolls, and the fact that the bill is fair, people will not, when they're filling out their income tax, be paying for their neighbor's loophole. If that is the accomplishment of this legislation. If business is going to make its decision on business practices as to how they can avoid paying taxes, I think that's the legislator's dream. Fairness, simplicity where you can get it, but a contribution to the government as opposed to avoidance of paying taxes. That is an accomplishment, and I think that, you know, if there's going to be a mark against my name, that is where I'd like to see it marked.
Certainly is. You sure can be proud of that. Chairman Packwood, do you have a list of provisions of which you are particularly proud?
It's interesting, Bob. Dan and I would have the same provisions. I would look at the low rates, which we both strove for and achieved. I would look at what we call the passive income limitations, and that's where people were avoiding paying taxes. And most of the people watching this show know what we mean by passive. You were writing off passive losses against active income and getting your taxes down to zero, legally. I mean, people weren't cheating. That's gone. And henceforth, people are going to invest for the purpose of making money, not for the purpose of tax losses, and I think that has to be good for the economy. And then lastly, the corporate and individual minimum tax, because if there's any problem that Dan and I have faced over and over when we go to our constituents, it's a question or a statement sort of like this. Well, I don't mind paying my share, but why don't they pay something? And this bill will ensure that they will pay something.
Chairman Rostenkowski, Chairman Packwood, welcome. As a veteran of the tax writing committees, I know that there are many that are going to take credit for some of the popular features of this bill. I think that it's never been clear in any bill I've seen that the lion's share of the credit belongs right here with you too, and I congratulate you. Now for my question. There has been some concern that this bill may have an adverse effect on an already troubled economy. Do either of you have any comments with respect to those concerns?
Well, I don't know that this legislation should accept the blame or the credit for what's going to happen in the economy. I believe basically that it's going to change a lifestyle for us. There's no question about that. And I would assume that there could be a downturn slightly. In the long run, however, I think it's been attested to by some of our more respected economists that in the long run it's going to have a favorable impact. But there are other problems that are going to contribute to what's going to happen in the economic future of this country. I'd like to think, however, that if we are ever going to come back to revisit the code, and that's the last thing I want to do, then at least it'll be on a fairer basis. At least when we review the code in the future, everybody will have an equal footing and be on a level playing field.
Chairman Packwood?
It was suggested that perhaps when the bill was done, conference was done, we should have hearings first and have some of the leading economists of the country come and testify as to whether the bill would help or hurt the economy. Well, first, most of them had written about it one way or the other, and you could catch their comments in the paper. It wouldn't have made any difference if we'd had hearings. We would have had 30 economists, and they would have split roughly 50-50 that it's going to help or it's going to hurt the economy. I'll come back again. The bill is fair. I don't run across many economists who say it's unfair. As to whether or not some of the relatively abrupt changes we are making in the investment tax credit, relatively abrupt in the passive loss provisions, are going to cause some dislocation. They are. Is it going to cause a downturn? I don't know. But I'll come back again to what I said a little earlier. If henceforth people are going to invest for the purpose of making money, they're going to be a little more cautious about their investment than if they are buying a syndicated share of a racing greyhound or a llama or a cattle feeding operation for the purpose of tax losses. And that, I think, will be good for the economy.
Well, if I could just comment on what Senator Packwood has said. You know, the most impressive testimony that we took in the Ways and Means Committee in the very beginning of this long journey, it was from the business community that was saying, give us an opportunity to make a judgment about how to invest our money based on good business practices as opposed to avoiding paying taxes. And I think that's significant. And I honestly believe that that effect will be felt by people generally. You're going to have people with more money in their pocket and more willing to spend it. And I think that in itself is a proud legislative accomplishment.
Well, and it's intriguing, Dan. Dan and I and Secretary Baker had a press conference earlier this morning. We are today approaching 500 businesses or trade associations that have endorsed this bill as it's coming out of conference. And it is a pretty broad cross-section, including some very capital-intensive industries of American business. And the bulk of them, now there are a few that don't like it, but the bulk of them are saying, we like the shot. We like the lower corporate rates. We're willing to trade off the loss of the investment tax credit for those lower corporate rates. You just don't tamper with it now. You leave it the way it is for 5 or 6 or 7 years and let us get used to it, but the bulk of business supports it.
The points that each of you have made with respect to the significant changes in the tax bill are quite accurate, and they do have far-ranging effects. However, certain critics of tax reform process have argued that this legislation could begin unraveling as early as next year. Are there any circumstances under which you might reconsider some of these tax reform proposals in the future? Chairman Packwood?
I don't think for the foreseeable future, Bob, and you've been around the process long enough, I'm not going to predict beyond 5 years. Who knows will be president, who knows will be in Congress. But neither Chairman Rostenkowski or I have any desire to come back and make major changes. Now, do you mean, will there be some technical drafting errors despite the care? There probably will. And we will probably have a technical correction act, but I think he and I are at one on this. We mean technical and nothing more than that. No significant substantive change.
Yes, Chairman Rostenkowski.
Well, I agree with what Bob Packwood has said. I would have to be convinced that the bill in itself was entirely responsible for changes or for a downturn. If that were true, I'm sure that we'd move to correct that. But boy, it'll take a lot of convincing for me to revisit this legislation. And Bobby, most businesses and in the conversations that I've had and the questions that I've taken, people want certainty. And that is really, I think, what we're going to try to give them in this legislation, certainty over a period of years.
Well, as one who labored in the vineyards of Treasury One and the President's proposal, I do want to add my thanks to both of you for what you've done. I as you know, had to ride herd on a lot of those tax shelter schemes out there that I hope now we're beginning to see the end of it. But let me shift gears with you just a little bit this morning. Chairman Rostenkowski, you have consistently argued that spending cuts alone aren't going to solve the deficit problems of the country. You've been an advocate of raising taxes if it becomes necessary to bring these deficits under control. As a matter of fact, at a recent conference on consumption taxes, you were quoted as saying that you would oppose a broad-based federal consumption tax, and you think instead that additional revenue could ease the federal deficit ought to come from higher progressive rates on income and not by a low regressive tax on need. So let me pose this in two questions. First, do you anticipate that Congress is really going to raise these new tax rates in the near future? And then when or under what circumstances would you envision that your committee would really take such action?
Well, I don't anticipate us raising the rates. That was in response to what I thought was an avalanche of favored opinion on consumption taxes. I just think that the rate structure is more progressive if you're going to tax, if you're going to increase taxes. I also couple that with my friend Ronald Reagan down at the White House. I'd like to, if he's going to support such increases, I'd be glad to join in the effort. And I'm consistent in that. But we've got a deficit problem in this country, and we're going to have to address that sooner or later. I'd like to shake a few timbers down at 1600 Pennsylvania Avenue and have them become aware of the fact that we've got a problem. We just cannot continue to cut programs. What we're all concerned about right now is sequestration, whether or not the Congress is going to be sequestered. And I've gotten some indications from the leadership in the House of Representatives that I should be looking at some excise taxes. Well, I'm going to do that because I'm a team player, and if the Congress, both the House and the Senate, think that that's necessary, I'm certainly not going to stop it. But I don't envision going back to rate structure for a long time into the future. However, I do feel that we raise rates or we raise taxes in the excise area at the people's peril, because for legislators, that's the easiest tax to increase in the world.
Chairman Packwood, in a recent meeting with a business group, you stated that the proposed tax rates would not be raised in the foreseeable future. And in fact, you think that we ought to leave this code just about the way it is, including those rates, for a long enough period of time so that people can get used to it, they can invest under it, they can begin to see how it works. So let me pose a couple of questions to you. Do you think Congress will be adding a new taxing system, such as a consumption tax of some sort? And if not, how do you see Congress dealing with the deficits?
Separate the immediate from the foreseeable future. The immediate is the Graham-Rudman totals right now, and can we get down below the 154 billion so there's no sequester. I think we will do that this year with no significant tax increase or revenue enhancements. There may be some kind of cigarette tax or gasoline tax or something like that, but nothing major this year. And next year, I think if we have to have significant revenues, and the President says significant revenues, we will do it not by raising the rates, but by again broadening the base and eliminating more deductions and more exclusions and raising the revenue that way rather than raising the rates.
Very good. Thank you.
Mark? Chairman Rostenkowski, the emphasis on tax reform during the 99th Congress has forced the tax writing committees to put aside a number of other issues, including Superfund taxes and, as you alluded to, some of the excise taxes. What tax changes do you think might be in store for us for the rest of this year or the start of next year?
Well, it all depends, Mark, on just how serious we want to be about deficit reduction. I'm conducting a hearing tomorrow and possible markup on where we're going to go with respect to increases in the tax area. Gasoline taxes are certainly high on the agenda because it's something I think that most members feel you can raise $6.3 billion, which is which is suggested to me by the Budget Committee that I have to raise. I think that you know, all the luxury taxes are there available for another hit. Presently, I have a measure before the Rules Committee on cigarette taxes, which of course is not necessary because we did raise $11 billion in the Tax Reform Act. But it all depends on how leadership, both in the House and Senate, want to play that. Do they want to use that and fly in the face of a president that said, I want revenue neutrality in this legislation? I'm for it. I would like to divorce the two of them because I think that that was a commitment we made to the American people, and I joined in that commitment. And therefore, I'd like to see us keep the reform bill separate and apart and neutral. If, however, we're going to have to avoid sequestration and revenues have to be increased, there are the various, you know, round up the usual suspects, cigarette taxes, gasoline tax. And I'm going to lay that before my committee tomorrow and see just exactly what the response is going to be.
We know, Mr. Chairman, when we were there, it used to be a little easier job for both of you, and Bracket Creep would pick up some money and you could give the people a tax cut. Now I think it's a much more difficult job to hold. Senator Packwood, what tax legislation do you expect to move forward in the 100th Congress?
I don't, Mark, foresee any significant new tax legislation. As I say, if we need extra revenues, I think it would be broadening the base by including within the tax base some things that have been left out, both personal and corporate. But the two big issues I see coming next year, if we don't meet them this year, one is trade legislation, and I cannot tell whether we're going to get a bill that the Senate, the House, and the President can agree upon. But if not, that's going to be a Donnybrook next year. And the other is Medicare, because the Social Security trustees are indicating that Medicare is going to turn into the red. And we're either going to have to find some way to contain costs or increase revenues or some combination of the two. And if we put it off and put it off, the problem will get worse rather than better.
Okay. That's good.
Let me pose something for both of you that's kind of near and dear to my heart. As you might recognize, we've had a lot of complexities added to the code in the 1982 and the 1984 acts, and there's even more pressure going to come on the IRS from this new legislation. Now we've got Graham, Rudman, Hollings, and all of these other problems, along with trying to deal with the deficits. Do you really see adding significant personnel to the audit and the collection and the taxpayer service functions of internal revenue that will deal with the whole problem of the decline in compliance? Because if we're not going to deal with that, then the compliance continues to go down. The self-assessment system simply doesn't produce what it should.
I've got a trust fund for Dan that'll take care of this.
We went through that, right?
The answer is yes, and I'll bet you that the chairman will answer yes also, that you're going to see more money appropriated for the IRS. You're going to see more agents. Some of the IRS have said that at least some of their compliance problems are going to be somewhat alleviated by getting rid of the distinction between capital gains and regular income, that from an enforcement standpoint will make it easier. But I'll wager you will see both the House and the Senate rather significantly increase the IRS budget through the appropriation process for compliance.
Good.
Well, I think the bill in itself, Roscoe, will give a psychological boost to the voluntary system. As I said earlier, we're responding to people that have been frustrated and disappointed. I do, however, and you knew when you were in the commission, I always supported more revenues, more employees. It was just the appropriations process that always stopped that.
I thank you for that, too.
But I do think that you're going to see people continue on the voluntary basis to make their contributions on April 15th, and I think the fact that we've done and we've got two rates and it's simpler for them, I think you're going to see that. But as far as compliance is concerned, I've no hesitation about increasing the amount of service employees.
Great, thank you.
That should warm the heart of a former commissioner of Internal Revenue, shouldn't it? Chairman Packwood, Chairman Rostenkowski, we really appreciate very much that you have spent this time with us this morning. in behalf of what I now hear are 20,000 people in our audience this morning, I know they appreciate the insights that you've given us, and we appreciate your sharing your thoughts.
Thank you. Nice to be here, Dominic.
We certainly wish you well in the final steps of this process and on your way to some historic action in the tax process, the tax legislation.
Thank you.
Thank you so much for being with us.
So long.
Thank you. Ladies and gentlemen, the second portion of our program is a summary of the major provisions of the Tax Reform Act of 1986. As we've already indicated, this bill is the most extensive rewrite of our nation's tax system in more than 30 years. It's obviously impossible for us to cover, in the time allotted to us this morning, all of these provisions. Therefore, some sections, such as those dealing with international operations, tax-exempt bonds, employee benefits, will not be included. Now, should you have any questions on any of these provisions, or for that matter, any of the other provisions, I know our colleagues across the country are anxious to respond. We'll certainly try and point out planning strategies as we go along in this analysis. However, I think it's very important to remember that each taxpayer situation is different. And it's very important that both from a one-time planning and long-range planning that you keep that in mind in order to take advantage of the opportunities and to anticipate the many new relationships that are created by this law. We will start this discussion with provisions that affect the taxes that we as individuals pay. And I'll ask Bob Shapiro to start us off with the new tax rates. Bobby?
Tom, as you're aware, the foundation for the new tax law is a broader base and lower rates. The new individual rate schedules are phased in over a 2-year period. For 1987, there is a 5-bracket rate schedule with rates ranging from 11% to 38.5%. Our first slide shows these rates for married taxpayers. The second slide shows those for single taxpayers. In 1988, there are only 2 tax rates, 15% and 28%. Beginning in 1989, rate brackets will be indexed to inflation.
This two-rate structure is a little misleading, in part because the benefits of the lower rates are phased out for high-income taxpayers. Thus, in 1988, married individuals with taxable income between $71,900 and $149,250 will have a marginal rate of 33% as a result of the 5% surtax on that income. For single individuals, the surtax is applied to taxable income between $43,150 and $89,500. The effect of this surtax is to produce a marginal rate of 33% on each dollar earned during the phase-out, but at no time will the effective rate be more than 28%.
The bill is also going to repeal the special deduction that we've known for long-term capital gains. That's been in the tax law since 1921, but with this new legislation, capital gains are going to be taxed at the same rate as ordinary income. However, during 1987, we're going to have a special rate arrangement which will hold the maximum tax rate on individual long-term gains to 28%, even though the maximum rate otherwise is a little higher. In 1988 and thereafter, however, the maximum tax rate for all income, including capital gains, will be 28%. But as Mark mentioned, the higher marginal rate of 33% will apply to at least some individual taxpayers, reflecting this phase-out of the benefit of the 15% rates.
Roscoe, because the tax rate on capital gains will increase in 1987 and thereafter, the wisdom of the day seems to suggest that those who are considering disposing of capital assets do so, or at least consider doing so before the end of the year. In fact, recent stock market action in the last few days would suggest that certain taxpayers are out there doing just that. What do you think of that advice?
Well, you simply cannot generalize about this. There is just no substitute for a detailed review of the circumstances in each and every case. A number of the factors that one must consider, of course, such as deductions that are geared to or based on the adjusted gross income, medical expense, and miscellaneous deductions are two of them. the investment interest determination, the applicable marginal rates, and of course this alternative minimum tax.
Well, what you're saying in a nutshell is that the conventional wisdom needs a very careful application.
Absolutely.
We are finally getting rid of the zero bracket amount, which none of us really ever accepted, and going back to the old standard deduction. And of course, our personal exemptions are being increased too. Bobby, why don't you fill us in on that?
Yes, the standard deduction is increased in the bill beginning in 1987 and then in 1988 to $5,000 for married couples and $3,000 for single taxpayers in 1988. An additional amount is provided for the elderly and the blind. Like the rate brackets, the standard deduction also will be adjusted for inflation beginning in 1989.
The personal exemption for the individual spouse, and each dependent will also be increased beginning in 1987 over a 3-year period to $2,000, and then indexed for inflation beginning in 1990. The new bill provides, however, that the personal exemption is phased out for high-income individuals. The phase-out begins at the same taxable level at which the benefit of the 15% rate totally phases out. For joint returns, the phase-out of the personal exemption begins at $149,250.
And Mark, the new law also provides that the personal exemption is not allowed to an individual who is eligible to be claimed as a dependent on another taxpayer's return. For example, where a child is eligible to be claimed as a dependent on his or her parent's return, that child may not take a personal exemption on his or her return.
You know, after we've only gotten through the rates and the exemptions, I have the feeling that if this is supposed to be simplicity, God save us from complexity. We've heard those rates. Roscoe, how about telling us about the current law credits, deductions, and exclusions that will either be repealed or modified in the new law?
Well, let's face it, we're going to be away from a number of the old familiar provisions that we've been watching for years. Many of them have been repealed outright. The two-earner deduction, for example, for married couples, income averaging has disappeared, and dividends received exclusion, and so on.
The conferees also broadened the base significantly in the area of itemized deductions. That was one of the major accomplishments of the bill, and that is the big deduction in the repeal of the consumer interest. That is auto and personal loans, credit card interest, and even the interest taxpayers pay on tax deficiencies. That repeal is phased in over a 4-year period.
Well, then, in other words, taxpayers should really reevaluate the cost of borrowing in light of the phase-out of the consumer interest deduction. And perhaps more urgently, they really should consider, at least those who owe money to the IRS, should consider paying the interest on those tax disputes before the end of the year so they can deduct the interest this year rather than having it considered as consumer interest in 1987. Bobby, there's been a lot of talk about the mortgage interest deduction. Please clarify that for us.
The Tax Reform Act limits the deductibility of interest for home mortgages under the bill. A taxpayer can deduct his mortgage interest on a first and second home so long as those mortgages do not exceed the purchase price plus any improvements on the home. Special exceptions, however, are provided for mortgage loans used to pay medical or educational bills.
Well, obviously planning then to substitute qualified mortgage financing for consumer debt should be considered early, and particularly right now, I suppose, with the low interest rates. It's important to note here that in order to take a deduction for a mortgage on a second home, it must be a qualified second home. I'll leave it at that point and just to warn our audience that there are some special definitions that should be attended to in looking at their refinancing, especially of second homes.
Yeah, Dom, let me mention another major change, and that's the increase in the threshold that taxpayers have to reach before medical expense deductions can be claimed. As you know, under current law, only those medical expenses which exceed 5% of adjusted gross are deductible. But under the tax reform bill, that threshold is going to be 7.5%. So taxpayers in a position to do so certainly ought to consider accelerating these medical payments into 1986 in order to take advantage of this lower threshold as well as a deduction against the higher tax rate.
Of course, taxpayers will have to remember that in 1987 and thereafter, capital gains, long-term capital gains, will be treated as ordinary income. And to the extent the taxpayer has those long-term gains, his adjusted gross income will now increase, and he'll actually need more medical expenses in order to trigger the deduction. So you have a higher AGI and a higher threshold, more medical expenses are going to be required in order to receive any tax benefit.
Well, that's certainly true. Let me mention another change, and this one, by the way, sparked quite a bit of controversy as it went through the process. That's the repeal of the deduction for state and local sales taxes. People need to remember that 1986 is the last year these taxes are going to be deductible. Some taxpayers who have been thinking about buying some large ticket items and so on ought to consider whether it might be worthwhile to accelerate those into 1986. I should also mention, however, that where sales taxes are incurred in a business sense, that is in connection with acquisition of property, they can still be capitalized and depreciated as a part of the cost.
The new law also revises deductions for meals, travel, and entertainment expenses. And here's an area of great simplicity, Bobby.
You're right, Tom. Not only that, but it affects each of us day to day. Under the new rules provided by the Act, only 80% of the cost of business entertainment will be deductible. Other changes include denying a deduction for ticket costs in excess of the face of value and also phasing out the deductibility of luxury skyboxes. The new law will deny the deductibility of 20% of the cost of business meals and require that the meal be directly related to or associated with the business. The present law rules on substantiation and the $25 de minimis rule will continue to apply. The bill also will deny deduction for travel as education and for certain charitable endeavors and for travel, meals, and lodgings for investment seminars. In addition, the bill also provides that the deductions for luxury water travel will be limited.
Let me mention also that employee business expenses, other than those which are reimbursed, must now be grouped with other miscellaneous deductions. I might mention such as fees for tax return preparation, and this group is then allowed only as an itemized deduction, and only that amount, which is more than 2% of the adjusted gross income, is going to be allowed as a deduction. And as you already mentioned, Dom, with the medical deduction, taxpayers need to be aware that treating capital gains as ordinary income in total will certainly increase the adjusted gross income in those cases, and therefore it's going to take more of these expenses to trigger the deduction. One exception I should mention, and that is that although moving expenses are now going to be treated as an itemized deduction at the bottom of the line, they are not subject to this 2% floor.
Mark, probably nothing got more publicity during this process than the IRA. What are the changes to this retirement plan incentive?
You're right, Tom. I think that this was in the House bill. It was out of the Senate bill. It certainly was up and down and ended up with the usual kind of a compromise. Under the new rules on individual retirement accounts, taxpayers who are not active participants in a qualified plan or who have adjusted gross income of less than $40,000, $25,000 for single taxpayers, can generally continue to deduct IRA contributions as under present law. The deduction, however, gets phased out as adjusted gross income reaches $50,000, $35,000 for single taxpayers. Above those limits, no deduction is allowed.
But Mark, even those taxpayers now may continue contributions to so-called non-deductible IRA under the existing $2,000 and $2,250 limits. Those contributions will not be deductible, but the tax on the income from those contributions will be deferred until the amounts are withdrawn. In considering that strategy, however, it seems to me that it's important to compare the after-tax income to be derived from that approach with alternative investments, such as tax-free muni bonds, to determine really whether the non-deductible contribution is worthwhile. Obviously, the benefit from an IRA contribution to a non-deductible IRA is the deferral of tax on the inside buildup until the funds are withdrawn. But other investments, such as state and local bonds, obviously the income on those instruments is tax-free.
I think that's absolutely right. The bill also lowers the maximum amount that an employee can elect to defer under a popular 401k plan, and that limit is now going to be $7,000. There are other changes, one of which is that the new law tightens the rules governing withdrawals from those 401k plans.
Now, probably one of the more significant provisions affecting individuals is a number of new rules aimed at denying taxpayers the ability to shelter income from taxation. How about the passive loss rules, Mark?
Well, you're right, Tom. This certainly hits many of our pocketbooks. I think this is perhaps the most well-known and the least understood is the passive loss limitation. Under the bill, taxpayers will not be allowed to offset losses from passive operations except to the extent they have activities which are passive, which produce income. Passive losses are defined as losses from any trade or business in which the taxpayer does not materially participate in all rental activities. In effect, a separate basket of income and losses has been established. It is important, I think, to repeat that with one exception, again, all rental income is treated as passive under the new rules, whether or not the taxpayer participates in the rental activity. The one exception allows $25,000 of rental real estate losses to be used each year by taxpayers who have actively participated in that rental activity if their adjusted gross income is less than $100,000. If a taxpayer's adjusted gross income exceeds $100,000, there's a special phase-out so that losses won't be deductible once a taxpayer's income exceeds $150,000. There is one other exception for new passive loss rules. It relates to investment in a working interest in an oil and gas operation. As to these, taxpayers will be able to deduct losses against any type of income.
Now, Mark, isn't there a phase-in of these rules for investments made before the date on which the President actually signs the bill? So that become a key element here.
There is, and before the conversation, Senator Packwood said he was going to announce the phase-in was only 1 year, and he scared all of us. There is a 4-year phase-in of the new rules for investments made prior to the date of enactment. Under the phase-in rules, only 35% of the loss is disallowed in 1987, 60% in 1988, 80% in 1989, and 90% in 1990. However, losses on investments made after the President signs the bill, which will be the date of enactment, will not get the benefit of any phase-in.
All right, but Mark, what happens to the disallowed losses?
Well, they don't disappear forever. Any disallowed loss may be carried forward, but these carry-forwards may only be used to offset passive income in succeeding years or may be claimed when the investor disposes of his or her entire interest in the property.
Well, in addition to these passive loss rules, I understand there's a whole series of new rules and new limitations on investment interest expense. Roscoe?
You're absolutely right about that. The tax reform bill also sets up another of what Mark has been calling a basket of individual income. So we'll call this one the investment basket. Under the bill, the investment interest may now only be deducted to the extent that there is net investment income. But this now includes capital gains, which I think is something new. But here's something to watch. When you're calculating net investment income, these passive losses that are allowed under this 4-year phase-in provision are going to be used to reduce the investment income. So that'll also limit the investment interest. Like the passive loss limitations, the net investment income limitation is said phased in over 4 years at the same rate, that is 35% in 1987, 60% in 88, and 80 in 89, and 90% in 1990. After that, no net investment interest may be deducted. But again, as in the case of the passive loss limitation, net investment interest that is disallowed can be carried forward.
But here again is another new interrelationship, if you will, and this is the interrelationship with investment interest and capital gains. To the extent possible, taxpayers may wish to structure transactions so that capital gains are realized in years in which the gain can shelter significant investment interest expense deductions. Now, we're not through yet on individuals because there's another new provision, and that is a strengthening of the minimum tax on individuals. Bobby?
That's right, Don. Once again, the Congress uses the alternative minimum tax as the backstop of the various provisions. In a number of cases, the conferees recognize that when they do not repeal the certain tax benefits that are available, that they must deal with the income sheltering that provides. In order to do that, they required those benefits to be taken into account for purposes of the alternative minimum tax, in which they expanded it in a number of respects. The new minimum tax takes effect in 1987, and the rate has been increased to 21%. The present $40,000 exemption, however, is phased out beginning at incomes of $150,000 for joint fathers. This means that the 21% rate would apply to the full alternative minimum taxable income, that is, the regular taxable income plus preference items. The minimum tax base generally includes the same preferences that exist under the present minimum tax, but in addition, the conferees added several new preference items to the minimum tax base that exist under present law. Among the major ones they added are, first, the amount of passive losses that are allowed during the phase-in period for regular tax purposes. Also, they added the untaxed appreciation of charitable contributions of property such as land and stocks and so forth. And also they added the excess of accelerated depreciation on personal property, this being for assets placed in service after 1986. And a brand new preference item, which for the first time focuses on tax-exempt interest. It includes the interest on certain state and local bonds issued after August 7th, 1986. The tax reform bill, however, also makes a modification to the minimum tax that provides a credit against the regular tax for prior year's minimum tax liability that's attributable to these deferral-type preferences. This means that a prior year's minimum tax can reduce a current year's regular tax.
The individual alternative minimum tax is really a delicate balancing act that will require careful planning to avoid its dragnet effect. If that wasn't enough with the new individual AMT, there are now a number of new rules just for real estate transactions. How about those rules, Mark?
Well, the first of these is an increase in the depreciable life for real property from 19 years, which it is under current law, to 27.5 years for residential rental property and 31.5 years for commercial property, beginning generally in 1987. In addition, transactions involving real property are now subject to the current law at-risk rules. However, there is an exception which many of us can live with. It's provided for qualified non-recourse financing secured by real property. Other changes that will affect real estate activities include modifications to the rehabilitation credit, a 10% credit for rehabilitating buildings placed in service before 1936, and a 20% credit for historic structures. In both cases, however, a full basis adjustment is required. The conferees also approved new low-income housing credits. Those credits can be claimed annually for 10 years. Although the mechanics of the credits are somewhat complicated, the maximum rate of the credit for property placed in service after 1986 is 9% for new construction and rehabilitation and 4% for the acquisition of existing housing. Both of these credits, however, are subject to the new passive loss rules and therefore are available only to those taxpayers who have net passive income.
Well, we can't change, and it's too late to change any of these new tax rules. 1986 planning, however, can lead to significant tax savings. Taxpayers should certainly consider accelerating their itemized deductions so that they will get the benefit of them at the higher tax rates, or to maximize deductions that otherwise will be disallowed or limited in the future. Similarly, taxpayers should really seek to defer income so it'll be taxed at lower rates. In addition, investment planning should take into account those financial instruments maturing after 1986 or 1987 when tax rates on that income will be lower. Now, taxpayers are going to have to do some out-year planning too in order to avoid finding themselves in a minimum tax situation, and that really could put them in a higher overall tax liability. That, in a nutshell, is our summary of the highlights of those provisions affecting individuals. We would now like to discuss some of the changes in taxation of business. Bobby?
Tom, the corporate taxation is significantly affected by the new tax law, as we all well know. Approximately $120 billion of additional taxes will be raised from businesses over a 5-year period. This money primarily is to be used to fund the reductions in individual tax rates that we've been talking about. The major corporate tax benefit is the reduction in the top tax rate from 46% to 34%, but this too is phased in over 2 years. Because the new corporate rates are effective for taxable years beginning on or after July 1, 1987, blended tax rates will be in effect for taxable years beginning before July 1987. This means that the maximum tax for a calendar year corporation in 1987 will be 40%. When the reduced rates are fully effective, corporations will pay a sliding scale, that is 15% for the first $50,000 of taxable income, 25% on the next $25,000, and the top rate of 34% on all income in excess of $75,000. Using the same concept as we have under present law, the benefits of the lower rates will be fully phased out for corporations with taxable incomes in excess of $335,000.
Let me mention another point, and that is the alternative capital gains tax rate for corporations. As you know, the corporations have had an alternative rate of 28%. Now this is going to be increased to 34% under this bill. That new rate will be effective for all the transactions taking place after January 1, 1987. So corporate taxpayers, at least, ought to be looking to the possibility of accelerating their long-term capital gains before the end of this year, so that they can look at the impact of doing it in 1986. Now, one thing to be aware of, and that is that that could have an effect for the add-on minimum tax that applies this year to corporations.
Just as we were getting comfortable with ACRS, the tax reform bill introduces or at least makes some significant changes to the depreciation system that was established in 1981. Mark?
Generally, the conferees retained all the assets in the 3-year ACRS class except for cars, light-duty trucks, and research and development property, all of which now have to be depreciated over a 5-year period. In addition, property previously depreciated over a 5-year period will now be required to utilize a 5, 7, or a 10-year life. However, such property can now be depreciated using a 200% declining balance rather than the existing 150% declining balance under present law. This means that the annual depreciation deduction for many items may not be significantly reduced, even though the life is lengthened. Certain other personal property will be required to utilize a 15 or a 20-year life and 150% declining balance. As already mentioned, real estate, which is 19 years today, will now have to be depreciated if it's residential over a period of 27.5 years and commercial over a period of 31.5 years, both under a straight line method.
For real estate, the straight line method is to be used, and Mark, also the new system will apply for all property placed in service after this year, except for property qualifying for the transition relief. That property, which will be subject to the ACRS rules, generally must be constructed or acquired under a binding contract in effect on March 1st of this year, that is 1986, and it must also be placed in service before a prescribed date. A special rule that was agreed to by the conferees provides that property placed in service during the last 5 months of this year, that is from August 1st to December 31st of 1986, which does not qualify for transition treatment, must be depreciated, or rather it may be depreciated at the taxpayer's election. You can either use the ACRS or the new system.
Well, then a key point to consider is that the 200% declining balance method may be used for personal property placed in service during the remainder of this year. And there really are some winners here, essentially those assets that retain their status as 3- and 5-year property under the Tax Reform Act's depreciation system. our clients and all taxpayers essentially should note this opportunity for the balance of '86.
That's right, Dom, and the new law also provides an alternative method of depreciation for certain types of property. That's property that's used either overseas or if used by a tax-exempt organization, or in part property that's financed by tax-exempt bonds. This type of property must be depreciated using the straight-line method, generally over the ADR midpoint.
One nice break for small businesses in the bill is the expensing of depreciable property. As you know, under existing law, you can write off up to $5,000 of acquisitions. This benefit now goes to $10,000, but there's a little sleeper in here, and that is the new rules are going to make it a lot tougher to qualify and tougher to hang on to the benefits of expensing. Taxpayers that make large dollar acquisitions, the expensing rules phase out for them on a dollar for dollar once they reach the level of $200,000 of acquisitions in any one year. So if you get the $210,000 of property acquisitions in a year, the expensing rule goes out and disappears. It's also limited to taxable income, that is taxable income from a trade or business. And you should note, too, that the benefit of expensing is recaptured whenever the property is converted to non-business use.
Well, in addition to these changes for depreciable property, one of the big revenue raisers in this bill, of course, is the repeal of the investment tax credit.
Yes, the investment tax credit, as a matter of fact, picks up, I think, something like $25 billion a year, and certainly it is a major device that has funded this bill. The investment tax credit will not be allowed for property placed in service after 1985 unless it qualifies for transition relief under either general or specific transitional rules in the tax bill. Generally, the ITC may be claimed if the property is constructed or acquired under a binding contract in effect on December 31st, 1985, and placed in service by various dates in the future. In addition to this general transition rule, a number of special transition rules were adopted. In fact, I think something like $6 billion worth. Transition property placed in service during 1986 and thereafter will be subject to a full basis adjustment. Also in 1987, credits on transition property and credit carry-forwards will be reduced by 17.5%. In 1988 and thereafter, those transition property ITC and carry-forwards for existing credits will be cut even further, down to 35%.
Mark, another change that affects the utilization of investment tax credit and other business credit is that the conference agreement made a retroactive change on the general limitation on the business credits under current law, that the utilization of certain of these credits is limited to $25,000 plus 85% of tax liability. Once the President signs the bill, the utilization will be limited to $25,000 plus 75% of the tax liability for these credits earned after 1985. In addition, any research and development credits claimed from 1986 and thereafter will also be included in this overall general business limitation.
All right, we've covered the changes in the rates and the cost recovery provisions. The conference also makes a number of other changes to the taxation of corporate activities. Bobby, give us some of those.
Yes, Tom. For example, the conference agreement provides new rules that start in 1987 for the treatment of net operating losses that replace rules enacted in 1976 but never used by taxpayers. Under the new rules, net operating losses and other tax attributes that are acquired by a company as a result of the purchase of another company will be limited. Generally, the allowable utilization will equal the value of the acquired corporation's equity on the date of ownership change multiplied by the federal long-term tax-exempt interest rate on the date of the ownership change. The new rules take effect for net operating losses after change in ownership of more than 50% of the value of the stock in the lost corporation. NOL carry-forwards will be disallowed if the lost corporation fails to meet the continuity of business enterprise rule that applies to tax-free reorganizations for the 2-year period following the ownership change.
Another important change that will affect the structuring of taxable acquisitions and liquidations is the repeal of the so-called general utilities doctrine. As you know, under general utilities, a corporation generally does not recognize gain or loss on the sale or distribution of its assets in connection with a complete liquidation or under a Section 338 election followed by a qualified stock purchase. Under the new law, that's changed. Generally, gain or loss will be recognized to a corporation on a distribution of its property in complete liquidation or under a Section 338 election as if it had sold the property at its fair market value. I say generally because there are exceptions for carryover basis distributions and essentially to some controlling shareholders and for certain tax-free transactions such as reorganizations. In this area, there are fairly generous transition rules which do prevent the new tougher provisions from affecting transactions completed or well underway this year.
How do you feel these new provisions will affect how leverage buyouts are structured, Mark?
Well, they're going to affect them, certainly. I think that leverage buyouts generally will be structured as stock acquisitions without a Section 338 election because the benefits of the 338 election have effectively been eliminated for these transactions. However, if the target corporation has net operating losses or investment tax credit carryforwards, the best use of the NOLs or the ITC may be against gain recognized on a liquidating distribution on sale. In that case, certainly the 338 election may be the most desirable way to go.
For a number of years, we've been hoping against hope for relief from the double taxation of corporate dividends. How did we fare on this, Roscoe?
Well, we haven't got there yet, Dom. As a matter of fact, even though this appeared fairly significantly in Treasury 1 and again in the President's proposal and even in the House bill, the conferees were just unable to retain it in the conference agreement, I think primarily because of the revenue considerations. And so a provision that would have at least gone part way in 10% deduction has been eliminated. So the conference agreement eliminates that. It also lowers, by the way, the intercompany dividends received deduction, which has been 85% for years. That's now down to 80% for dividends that come in after 1986.
There's a tough new 20% alternative minimum tax that replaces the present law add-on tax for corporations. And this begins in 1987. It's another dragnet provision and includes a significant new and rather unsettling concept. Mark?
It does, and it's certainly going to keep us busy. The new 20% alternative minimum tax is a true alternative minimum tax and will be paid if it produces a higher tax than the regular tax on corporations. The alternative income base will include preference under existing law similar to what Bobby stated for the individuals, as well as a number of new preferences. The new preferences here, however, have been expanded. They include installment sales to the extent they are permitted under the new law, use of the completed contract method of accounting, as in the individual case, untaxed depreciation on charitable property given to charities, accelerated depreciation for most tangible personal property placed in service after 1986, as in the individual case, interest on certain state and local bonds issued after August 7th, 1986, and the big one, which is 1/2 of the excess of pre-tax book income in excess of other alternative minimum taxable income. The book income preference is one of the most controversial items in the bill, in my judgment. The Senate Finance Committee report states that the book income preference was intended to ensure that any corporation reporting book income to its shareholders would have to pay some tax. The book income provision will be in the law for only 3 years, 1987, 1988, and 1989. And after 1989, the book income preference will be replaced by a preference based on earnings and profits, but with various adjustments yet to be defined, and we'll have to look at the statement of managers. In order to prevent taxing deferral preferences twice, like the individual tax, alternative tax, the alternative minimum tax here paid can be credited against the regular tax in future years.
There really are some real complications here for many companies, and we expect that many will have to pay the alternative minimum tax. The new AMT certainly requires significant new accounting records and will require extensive additional planning. I'd like to turn now to a discussion of the major tax accounting changes mandated by the Tax Reform Act of 1986.
Tom, certainly some of the more complex changes in the accounting provisions are the rules requiring capitalization of costs related to inventory, construction, and development. These rules, which are similar to the present capitalization requirements in the rules for extended period long-term contracts, will now require taxpayers to include in inventory all of their indirect production costs that were previously expensed, and so on. The rationale behind this rule is that the costs which either benefit or which are incurred by reason of productive activities should be allocated to such activities. These rules are effective for inventory produced or sold in the first taxable year beginning after 1986. Thereafter, taxpayers will need to adjust their beginning inventory balances. The costs, which will make up the major portion of the adjustment, will consist of things such as excess tax depreciation, distribution and warehousing costs, G&A costs, which are incident to taxpayers' activities as a whole. The bill contains an exception, however, for wholesalers and retailers whose annual gross receipts are under $10 million. These rules will also apply to assets which are constructed for self-use. However, expenditures for repairs and maintenance that do not relate directly to the production of property will continue to be expensed as they are under present law. The bill also contains a special rule for interest expense that requires capitalization if the property is real property, if it's long-lived property, or property requiring more than 1 or 2 years to produce it.
Roscoe, the new Tax Reform Act also will deny the use of the installment method for sales of certain publicly traded property and sales under a revolving credit plan after 1986. Any adjustment required by the change in accounting method will be spread over a period not exceeding 4 years. Other than for revolving credit plans, use of the installment method is going to limit the amount of gain that may be deferred based on the ratio of the taxpayer's debt to assets.
That's right. Another accounting rule change repeals the reserve method for bad debts. This too is effective in 1987. The new rule applies to all taxpayers except certain financial institutions. Balances in these existing reserves will be taken into income over a period of 4 years for a phase-in. However, slightly different rules will apply to banks. So corporate taxpayers ought to scrutinize their doubtful accounts before year-end. An increase in the 1986 reserve could also yield time value of money as well as rate benefits.
The conference agreement also denies, beginning in 1987, the use of the cash method of accounting for corporations other than S corporations. It denies it for partnerships with corporate partners and tax shelters. Exceptions from this rule are provided for businesses with average annual gross receipts of less than $5 million, sole proprietorships, farming and timber businesses, and qualified personal service corporations. An adjustment required by a change from the cash method is to be taken into income over a 4-year period here.
That's right, and there are also changes for accounting periods as well as the accounting methods. This conference agreement requires that partnerships, S corporations, trusts, personal service corporations use a taxable year that generally conforms to the taxable year of its owners. This provision applies to taxable years beginning after 1986, and any additional income that is required as a result of the change in the year, and so that we have a short year, will mercifully be spread over a 4-year period.
Well, I want to thank my co-panelists. This has been a fast but intensive review of the highlights. Ladies and gentlemen, you have heard from our distinguished guests from the Hill and I might say my equally able colleagues in describing some of the new provisions of this Tax Reform Act. It's time now that we hear from you. We will now take questions for participants at teleconference sites around the country. Please bear in mind that the answers you will get will not be encumbered by our having looked at either the statute or the committee reports. We will, however, give you our best informed judgment of how these provisions will work in response to your questions. The voice you will next hear will be of a Price Waterhouse moderator on the scene. Our first question comes from Peter Hart in Philadelphia. Peter?
Good morning, Tom. A member of our audience here would like to know or like to have some
Could you
specifics.
speak, could that come across a little louder, please?
Municipal bonds that are going to be subject to the new alternative minimum tax. Could you help us out with that?
May I ask you to repeat the question, Peter, and a little louder, please?
Tom, one of the members of our audience would like to know, like to have some specifics on the types of municipal bonds that are going to be subject to the new alternative minimum tax rules.
All right, gents, who wants to take a crack?
Peter,
at that?
this is Mark speaking. First, what we know as general obligation bonds, those really that have are backed by the full faith and credit of the state, are not the type of bond that are going to be included in the minimum tax. Also, most of the bonds issued by 501c3 organizations for schools and so forth, those also are not going to be in the alternative minimum tax. What's kind of left that will be in the minimum tax if it's issued after August 7th are traditionally what we know as industrial development bonds. There are a couple of other categories besides industrial development bonds, student loan bonds and what we call mortgage subsidy bonds. So it's really the industrial development bonds, the student loan bonds, and the mortgage subsidy bonds issued after August 7th that will be in the minimum tax. That's a little misleading in this sense, and that is that this new book income preference, obviously 1/2 of the excess of book income over this alternative minimum taxable income also is a new preference on the part of corporations. So as to them, obviously any tax-exempt bond that they have certainly could find its way into being taxed. I would assume in the future, if I am investing in a municipal bond fund, that somebody is going to have to tell me at the end of the year how much interest that is going to be in the minimum tax and how much interest that I've had tax-free doesn't have to be in the minimum tax.
Our next question comes from Craig Duncan in Anchorage. Craig?
Good morning, Tom.
Good morning, Craig.
A lot of our clients have been involved in real estate activities over the years with installment sales. We're curious about what happens to an installment sale executed in a prior year where payments will still be received after 1986. Will the seller's capital gain collected after 1986 still be subject to the maximum 20% capital gain rate, or will the new rates apply?
Bobby, do you have a brief answer to that question?
I think so, Dom. Generally, the way the rules usually work is whenever the Congress changes the tax rates, it is the new rates that apply whenever the payment is received. And I think that would apply in this case. So if you have an installment sale in a prior year, it is when you receive that cash payment, the rate at that time would be imposed on that payment.
Carl Kantner in Cincinnati. Carl?
Good morning. Good afternoon, Dom.
Good afternoon, Carl.
May an employee elect to defer his salary for the remainder of 1986 to 1987 to take advantage of the lower tax rates?
Well, I think, let me take a crack at that one. There is certainly reason to believe that an employee can defer his salary, certainly for 1987 by an agreement entered into before the beginning of the year, and even for 1986 for income to be earned over the balance of the year. I think the IRS position, as far as rulings are concerned, would insist that those agreements be entered into before the start of the year. However, the courts have been more lenient and have honored agreements that have been entered into even during the year, as long as that agreement is entered into before the work has been conducted and before the individual had a right to receive those funds. We, of course, giving this answer, again, without benefit of seeing the committee report, I would suggest that that would be, if you're going to enter in one of those agreements, we should quickly look at the committee report when it's available. If there's need be, those agreements obviously could be rescinded and the individual would be back no worse than where he was before. Thank you, Card. John Fapiano in Boston. Good morning, John. Good afternoon.
Here in Boston, we've had a substantial run-up in real estate values, and it seems that the only tax shelter, or one of the few tax shelters left, is the mortgage on the roof over our first and second residences. In that context, what will qualify as a mortgage loan so that interest will be deductible under the new provisions?
John, I think the only thing we really know about that up to this point is that the loan must be secured by the taxpayer's principal residence or second home. We don't really have any more details until we've seen the statement of managers and most likely until regulations are issued on this. But I think if the loan is secured by some sort of a security deed or a mortgage on the taxpayer's home or second home, I think you can assume it'll be home free.
Charlie Hogue in Miami. Charlie?
Good afternoon, gentlemen.
Good afternoon.
The question from Miami is, can income still be shifted to children in order to have it taxed at their lower rates?
Charlie, the Congress and the Tax Reform Act conferees were concerned and dealt with the shifting of income from a parent to a child, and therefore provided a rule that provided limitations to doing that in the case of a child under the age of 14. In effect, what that says is that when you're under 14, that the unearned income that you receive would be taxed at the parent's tax bracket. However, there are certain limitations to that, or let's say modifications to that, and that is that it's only the income in excess of $500. So the first $500 would be subject to the child's rate. The child also has a standard deduction of $500, and so therefore it's only the excess of $1,000 that would be taxed at the parent's marginal rate. Another rule that was provided is that to avoid having two personal exemptions is that if a child is being taken on the parent's tax return, you no longer get the personal exemption on the child's return, and therefore that is disallowed. I should point out, however, that all salary and wages, that is earned income of the child, is still taxed at the child's bracket. It is only the unearned income, wherever it's received, would be taxed at the parent's tax bracket.
Good morning to Tony Sporer in San Jose, and I'd ask you, Tony, to lower the audio a bit as you ask your question.
Good morning, Don.
Good morning. You're coming through very well.
Great. Our question relates to the statement made by the panel indicating that the meal deductions are now only 80% deductible. What about meals when an individual is traveling out of town? Are they fully deductible or only 80%?
I'm afraid, Tony, that there's mostly bad news with this whole T&E and the 20% haircut on those deductions. The 80% allowance, if you will, applies to business meals whether or not you are away from home overnight. Although, again, there's some difficulty in ferreting out some of the obvious complications that are going to occur in administering this provision. It would appear that the 20% disallowance does apply across the board, even when you're taking meals while away from home. There are many special problems here, obviously, especially in those situations where the meals and the lodging may be linked together, especially on American plan provisions and the like in certain hotels. We'll have to wait to see how those are being interpreted, but I rest assured there's going to be an effort to identify the meals as well as the lodging component in those areas. We have a question from Paul Kiffner in Cleveland. Paul?
Thank you, Dominic. On behalf of our corporate guests here today, let me ask a two-part question that's been asked of me on several occasions. When will the new lower corporate rates be reflected in increased earnings? And more specifically, what about all of the deferred taxes recorded at the 46% rate in the balance sheets?
Well, that's obviously a very important question. Let me say quickly that the issue concerns the taking down of some deferred tax liabilities. I'm afraid that the benefit, if you will, cannot be recorded until 1987 at the earliest. The FASB, as you know, which has jurisdiction on such matters, is right now reviewing the deferred taxes and tax accounting, if you will, on an overall basis, and is also specifically addressing how the elements of this new tax bill are to be given an account. Last month, or earlier this month, the FASB did pronounce a exposure draft of a revision to APB 11, which would suggest that deferred taxes are to be adjusted when there is a change in tax rates. On the other hand, this proposal isn't expected to be adopted until sometime in 1987, and until then, companies are really prohibited from taking account of any changes in the deferred tax liabilities as a result of the changes in rates. As to the specific implications of this bill, there are some retroactive provisions, as you know, the ITC repeal, the restoration of R&D. The FASB is addressing that and is expected to say that those items are to be taken into account in 1986 accounts. We have a question from Dennis McDade in New York. Dennis?
Good afternoon, Don.
Good afternoon.
In this troublesome question of book income, how is book income defined for the preference item in the alternative minimum tax? And secondly, must the alternative minimum tax, including the book income preference, be paid as part of the quarterly estimated tax payment?
Dennis, this is Mark. It is certainly troublesome. What they have done in the statute is to set up applicable priorities, and the first priority is a financial statement required to be filed with the SEC. If that's required, then that is the amount that you will use for book income. The second priority is audited financial statements that are used for credit purposes or shareholder reporting or other non-substantial tax purposes. And if you did not have one that was required to be filed with the SEC, but you did have an audited financial statement of the kind I just described, it would have to be the one that gets used. The third is an income statement required for a federal or state agency. And then finally an income statement used for credit purposes. So you go down the list of priorities, and whatever that item was that hit the priority would be what would be required to be reported in book income.
Well, I believe we're almost out of time, and we appreciate the questions that we received from so many sites around the country. I'm sorry that we haven't more time to answer them. I know, as I said earlier, our colleagues in those sites will be very anxious to help you with those questions. As I said at the start of this presentation, it was really our intention to focus your attention and your early attention on the many aspects of this bill that require thoughtful consideration. I hope we have been successful in convincing you to plan now. Plan now for 1986 and beyond. You will be receiving a complimentary copy of the Price-Waterhouse Guide to the New Tax Law when it is published later this month. This publication will point out even more planning opportunities, but of course, if we can help you in this massive and very important planning effort, we certainly look forward to doing just that. On behalf of my colleagues here in Washington, Mark, Bobby, and Roscoe, we thank you very much for joining us, and we wish you all a very pleasant day. Thank you.